Welcome back to All Things Money. I'm David Blain, and today we're talking a lot about the continuation of the bull market in equities and just kind of review of what's happened the past year of the global bull market, as well as where we think things might be going in the future. So before the break, we made the case for the continuation of the bull market. During this segment, we're going to talk a little bit about things that you should be looking for that may indicate a correction looming on the horizon. One thing that I'll point out is that as of right now, we do not think that the year 2010 will bring another bear market. And you hear the term correction and dip, correction, bear market. Each person or company, whoever uses these terms, has very specific meanings behind them. We view as a correction as somewhere between around a 5 to 15% decline, and a bear market as anything greater than a 15% decline, and a severe bear market is anything greater than a 25% decline. And so, don't get wrapped up in the exact percentages, but just know that a correction is a less severe decline than a bear market. And so one of the things that we are looking at is the possibility of a correction in the year 2010. There's several reasons for this. Number one is this advance the past year has been really impressive. And stocks are what we call overbought, meaning that they've gone up so much that they can't possibly continue at this rate, obviously, forever. One of the things we look at is the advance of stocks versus bonds, and we look at the global stock market advance versus the bond market advance, and we've reached a point of what's called 2 standard deviations above the norm. And what that means is that stocks have gone up significantly more than bonds than they normally do. A 2 standard deviation means that this type of event would only be expected to occur around 5% of the time. And so we see that stocks have gone up significantly more. If we go back to March of 2009, the ratio is flipped, and we had a 2 standard deviation event of bonds outperforming stocks. And so when these things get out of line by so much, they have a tendency to reverse and go the other direction. And so that's something that we're looking at very, very closely. The other thing that nobody is really sure of the exact reasons, but the seasonality, meaning different time periods within the year, we're entering a very unfavorable time of the year for stocks. You may have heard the saying, sell in May and go away. Well, there's some statistical data behind that shows the average correction between a March, April high and a May, June low has been around a negative 9%. And so we typically see this pattern, but just as the pattern seems to be something that you can follow, inevitably it will stop working. So we don't want to put our whole weight of the evidence on this one thing, but it's just something to look at. That traditionally, somewhere around April and May, the market declines until the fall. The other thing I'm big on that I'm always talking about is sentiment. Once again, sentiment is the relative optimism or pessimism of the participants in the market. Ultimately, the stock market is about the emotions and the actions of the participants in the market. And it doesn't matter if you have a company that is worth X amount of dollars. If nobody is going to pay that, then they're not going to pay that. Ultimately, as Warren Buffett and some other people say, over long periods of time, the market should work out. But certainly in the short and intermediate term time frame, the stock market is one thing. It's very emotional driven. And so we look at sentiment indicators. And interestingly, on sentiment, you want to sort of go with the flow until sentiment reaches an extreme and then reverses. And so right now we're at very high optimism levels. And this is very dangerous for the stock market. Typically, when the optimism of the market participants, individuals, professionals, reaches very high levels of optimism, then the market is ripe for a nice fall. Once again, we want to stay with the direction of the market until it reverses, but it is a dangerous sign that we're seeing right now is the optimism increasing. Another thing that we look at is bull markets also typically have some things to look at, and so since we've reached the end of 1 year in the bull market, I thought it would be interesting to take a look at historically what happens in the second year of a bull market. And so historically, in the 12 months following a 1-year cyclical bull market, we call it year 2, the median percentage gain on the S&P 500 has dropped from about 29.2% to 9%. What does all that mean? It means that typically when you have a bull market that started last March, the second year you typically have much, much lower gains than the first year. Now, it doesn't mean that, if you've been sitting on the sidelines this whole time, it does not mean that, you still can't make some money. It's just that a lot of the, quote, easy money has already been made in the market, and it's going to take a little bit more time and effort to get the same gains. For bull markets that occur during a secular bear market, the returns have gone from 30.1% to 7.4%. And remember, the United States has been in a secular bear market since 1999. A secular bear market means a multi-year period of declines. And we've talked about that on other shows, but just know that within a secular bear market, the returns in the second year of a short-term bull are even more muted than if you're in a secular bull market. Some of the other things that we look at, which sectors and industries are performing well, and we may get into a little bit of that after the break. But for now, we're going to take our second break, and on the other side, we'll be answering some viewer mail as well. For All Things Money, this is David Blain.